Jigar Mistry of Point Capital is here with us. Jigar, thank you very much for joining us today. We are chatting after a long time, Jigar, but the broad view is that RBI will actually be heading towards a pause. That's fine. That's the broad view. I want to understand a step beyond that. Will it be right to assume that in the next 6 to 8 months, forget the pause, but actually a rate cut cycle could start in India? Or do you think that is, going a little ahead of the curve now?
Hi Ajay, thank you for inviting me to your show again. In English, yes, after a long time. Uh, See, I think you are broadly right. I think the core is that the inflations, if you look at across developed markets, it is sort of cooling off. In India, the RBI policy, at least in our opinion, had moved towards managing the currency rather than the inflation, because inflation wasn't really as big a trouble for India as much as it is for the West. And whereas in the West, your sort of core inflation is still above 5%. So the base case is that the RBI would follow the West, where they continue to sort of keep the rates at a flattish 5 quarter on the Fed fund target rate upper bound. And then we will continue to maintain the differential with two caveats. The first part is that if you look at the differential between repo and the FFTR upper bound, then that's today at 125 basis points. Now that is the lowest number that we have seen in 23 years. Correct? It has never been lower. Now, if you juxtapose this again, what could potentially happen? If, with the recent announcement, if oil starts moving towards 80, your net FDI, the gross FDI continues to be very strong, but net FDI is almost at a decadal low. And let's not forget that there will be 280 billion of billion dollars worth of short-term maturities that will come up for renewal in the next 9 months or so. So if like a perfect storm were to happen, where the oil goes to 80 plus, your FDI continues to remain low, FPI, which has turned positive since March, sort of flat lines, and at least say half of the short-term maturities actually get refinanced in India, then I think what you are suggesting could be very difficult, as in the RBI might have to maintain the rupee levels and therefore not cut as fast as the Fed does. Something which is something very similar to what happened in 2006 to 8 cycle, right? 2006, we were again at 125 basis points, but with the cut in the West, we could not follow. So the differential, which was 125 basis, actually increased and expanded to something like 800. Now, again, that was a different time. The Indian economy is a lot better in terms of macros compared to 2008. So we're not suggesting we could go back to those levels, but this is something we keep in mind at the back of our mind as a non-zero probability.
Jigar, what's your positioning right now at Buoyant Capital? How are you guys approaching the market in terms of what are the three, four largest overweight positions, and also are you running some cash or fully deployed?
Right, Ajay. So, since March, if you see like a glance on the market, whereas the index since 28th March, if you take Nifty, that's something like I'd say 10% higher. But if you look at the breakdown of that, some 75 odd percent companies of BSE 500 has outperformed the Nifty. Number one. Number two, some 13% plus companies. So 150 sort of number of companies have actually given returns in excess of 40% in just the 2 months. So a lot of the small and mid caps which were battered down completely in March have really risen very, very smartly. And obviously our fund has benefited with some exposure there as well. But as we speak, there are a few things which are positive. There are equally a number of things that, makes us cautious. But in terms of positioning, I would say that we are running something like 14 odd percent in cash. And our exposure to small cap in the month of March was much larger, closer to 50%. And with the smart rally that a lot of the small caps have seen, we are, booking out where things are looking a little bit heady. So, yeah, we can continue to sort of look at, a balanced scenario rather than getting swayed away with what's happening in the markets.
Plus, where you're booked out Talk to us about areas where you're completely book profits right now.
Not completely. See, with us, Jaya, what typically happens is that weight is a very active part of our strategy. So, if the business actually moves into zones which is uncomfortable for us, we do reduce weights. And one such space where it warrants some amount of understanding is the banking and financial space. Right now, banking, we have, as far as I can remember, I have only spoken positive things with you, but if you break it down in those 3 or 4 cycles, we are possibly looking at almost everything being priced to perfection. It's not expensive, but we were running a very large overweight position in banking in the run up here. And it's time where we are looking a little more towards NBFCs rather than banks. So if you look at the credit growth cycle, that continues to be very sharp. Although at 15% data that we got, 15% growth number that we got for April, my sense is that towards December that could moderate a little bit given the base effect. Your NIMS cycle, which will sort of see some amount of contraction, especially for the private guys. Your credit cost continues to be benign, so I don't think we are looking at credit cost rising in a hurry. But the fourth cycle, which we typically look at, is the valuation cycle, and there adjustments have happened. So from 2018, the way we looked at the smaller banks, then smaller banks like ICICI and SBI catching up to HDFC, a lot of other investors played the same thing with the PSU pack, where they bought a lot of PSU banks compared to SBI. And I think now that alignment has happened, and some amount of sort of opportunity do exist in smaller banks where we are active. But I think NBFC as a space over the next year might get interesting. So if your credit growth continues to remain strong and cost of borrowings for most of them have come to a peak level, then over the next 3 or 4 quarters, you can see NIMs for most of them being much more comfortably placed. And they are not really sort of as expensive as a few of the banks have gotten. So incrementally, I think NBFCs, could it be in MFIs, those spaces look relatively much more interesting.
NBFCs, what exactly would you buy? Would you buy microfinance? Would you buy the tech back kind of NBFC plays, the traditional ones, Bajaj Finance or Poonawalla Finance, or even some of the kind of MFIs, which are doing very good numbers, all of that? What would exactly interest you in NBFCs?
MFI space, Ajay, as you mentioned it, MFI space tends to be, see, MFI is sort of the highest cyclicality in the lending business, you can see, because their average tenure tends to be something like 13, 14 months. And that's like you're replacing, a large part of your portfolio every year, every 2 years. That's not an easy business to run. And that also is actually very, very localized because factors like Amphan or floods or some or the other state sort of taking some moral hazards, as in loan waivers, etc., does impact their business. So when you are looking at an MFI business, one needs to be extra cautious. But the way we see the undercurrents today, after 2 or 3 Cat 3 events in succession, we are now in a scenario where the business is looking reasonably okay. Credit cost for most of these companies have come down dramatically, and valuations have not really caught on. So within the NBFC pack, also I think MFI looks very attractive to us.
You may have seen, Jigar, that the if you look at the small cap index, it's still 15% away from all time high, whereas the mid cap is already at all time high. Banks and Nifty almost nearing there. Would you stay away from small caps, or would you start looking for value there selectively?
Right. So, Ajay, if you see, say, a 20-year sort of horizon, your Sensex has given something like 17% CAGR, your small cap has given something like 19% CAGR. But both those indices have very different cycles in and of itself. So, for example, if you were saying December 2017 and believe that both those indices give you similar results, then over the next 2 years and 3 months, the large cap index was down something like 12% and the small cap index was down 50%. So I think there are sort of individual cycles that these follow. In 2017 end, I remember just before the long-term capital gains budget was introduced, the small cap index has actually created a huge high, and I think a lot of alternatives, a large part of mutual funds were actively deployed there. and then the experience that followed in the next 2.5 years, I think a lot of them swore off. So I think the small caps are just catching up to it. Beyond the point, it's good to sort of know these cycles and operate within them. But eventually, what we are buying is a business which is interesting, offered to us at a value that makes sense. So I think if we do a bottom up basis, then few businesses are interesting, which is where we are also positioned in the sort of small cap space. But some places it does look heady. Some places, they're not even pricing in. So I won't read too much into the fact that because 2017 was such a huge high and we have not caught on, the components of the index have changed. So the ones that were leaders back then are not really taking the lead this time around.
All right, Jigar, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
That was Jigar Mistry of Boeing Capital. A bit cautious because they already have been riding a good rally, but not, kind of not running away from the market yet. In fact, looking at opportunities, some of them are MFIs in the MFI space. Let's take a short break for news and analysis on the other side of the anywhere.